Hey, Facebook land, it's Marquette Redham and my sidekick here.
Oh, I'm the sidekick?
Today you are.
All right, yeah.
Paul Redham.
Yeah.
You're never going to get the hang of introducing yourself on Facebook, are you?
Oh, hi, I'm Paul Redham, and it's nice to be here with you.
Yeah, so welcome to episode 7 of Calls with Paul. Yep. Today we're talking about real estate investing.
Yeah.
And so first of all, let me ask, if you guys have any questions, please drop them in the comments below. And give us a thumbs up if you can hear us, or let us know in the comments if there's any kind of technical difficulties or anything like that. Real estate investing, it's funny to me. So I came from a background, you know, a not very affluent family. In fact, we were pretty poor. I grew up in a trailer house, and the idea of real estate investing is not something that was ever talked about in my family. It was a foreign idea. And even to this day, you know, being married to a realtor, we do real estate investing. And but even now, my dad gets nervous when we talk about buying properties and investing in properties or flipping properties. And he's very worried about, you know, losing money and not being a smart decision for us. By the way, he's 70 today. So happy birthday, Dad.
Happy birthday, BJ.
Yeah.
I think he's watching.
No. No. But with that kind of mindset, and then other people kind of come into it with this idea that real estate investing is definitely a way to build wealth. Where do you know, you're experienced in the area, so kind of
Yep.
where do you land on it?
Well, I think that holding real estate for the long term is by far, without a doubt, the best way to build wealth. It's a long-term game. It's not a short-term one. Different investors feel differently about how they go about it. But the good news about real estate is it's very forgiving. And do you want me to talk about my two basic?
No, not yet. I mean, I think it is a way to build wealth. I mean, we've had success with it. I know other
Yep.
people that have had success with it. One of the things that I think that you taught me early on is that real estate investing is cool if you do it right, because you basically use someone else's money.
Yeah.
Whose money are you using?
Somebody else's.
A lender, usually,
Yeah.
a bank or whatever.
A lender, a bank.
To buy a property.
Yep.
And then if you do it really well, you get someone else to pay.
Pay that debt.
To pay that debt.
You pay nothing other than a few headaches here and there.
So it's basically a tenant. You borrow money, and then if you are able to get a good deal, you get your tenant or whoever your renter it is to basically be paying enough in rent to cover the cost of the mortgage. Yep. And so then you let that property appreciate. So yep. I think it's interesting. And I think we've been to a lot of dinner parties where I've heard you tell this story about, you know, as a real world example about the benefits of investing in real estate versus the stock market.
So sure.
Share that with
the story started sometime in the 90s, so the numbers are way off. But as a young guy, I would be inevitably at parties where I was a real estate guy, of course. And then I'd meet with financial planners, and we would all have this discussion of like, well, who can make the client the most money and the fastest? And the financial guys are always like, well, we do 12% or we do 6% a year or whatever. So the illustration that I developed over time was, gosh, let's just pretend like for a second that we both have $100 grand and we're going to put it to work, and everybody agrees that that's a good idea. So the financial advisor says, okay, I'll put my $100 grand to work, and I'll make 6 or 10% or something like that for our client. And I say, okay, well, I'm gonna take my $100 grand and I'm gonna pocket 95,000 of it. And I'm gonna put $5 grand down on a rental property. At the time, you could do that. You can't do it now. But let's just, so you put $5 grand down.
Maybe if you put 20% down.
Well, if you put 20% down, fine. So we still have that in our $100 grand bank account. Mm-hmm. So we put 20% down. We owe 80, and it doesn't take long for that 20% to double. Like, so the home only has to go from 100 to 100, in this case 140 if we're putting 20 down for it for us to double our money. Where for the financial advisor, for him to double his money, it takes a whole lot longer.
Yeah, he's basically got to appreciate 100% in the stock market for that stock investment to double its money. But because you're able to leverage
That's right.
money in real estate, you can quickly make a lot more than you've put down.
Your return on your cash in because of leverage is huge, and that's the beauty of it.
Right.
And then you can, and everybody gets that kind of with owning their own home, but it gets even better with an investment property when you have tenants who are funding that debt.
So you're not coming out of pocket for it.
And a lot of investors, they start out with losing money because they want to have a high quality area. Maybe the rents don't quite make it up, but over time it starts to.
Let's talk about that. So you said there were two different kinds of investors. Tell me a little bit about those two kinds of investors, and we'll talk about them separately.
So, they follow the spectrum, but on one side of the spectrum, you have guys who really want cash flow, and there's nothing wrong with that. That's good investment philosophy. They deal in Excel sheets and capital cap rates, return on your capital.
What's a cap rate?
Well, so if you have $1, how much are you making on that dollar? So there's your capital, and then so if you put $1 out, can you get $1.10 back? So that's the thought process there. But those guys really get involved in that kind of side of things. And then there's other folks who want to buy a nice rental property in a great location. They're a little bit more safety oriented. They're putting most of their investment is really involved in the land, less in the structure. The rents probably don't equal what they're paying in a total mortgage. But over time, the idea on that one is that appreciation is going to be the real winner because you're buying in a prime area and you're probably putting high quality tenants in it. So if you lose $300 a month and you're appreciating at $2 or $3 grand a month, well, that's okay.
Well, let's dig into that just a little bit more. So on the cash flow model, you're looking for properties that are going to generate income right away.
Right.
I'm assuming, and you correct me if I'm wrong, that because of Austin's increase in appreciation in recent years, that it's kind of hard to find those in Austin proper.
It is. We used to be able to back to that story. We used to be able to find homes for $100 grand, and then they would rent for $1,000. That doesn't happen anymore. Now you find a home for $100 grand and it rents for $700. Not that you can find a $100,000 home, but I think you guys at home can do the math and figure out, so you buy a $700,000 property and maybe it rents for $3 grand.
Or maybe you do multifamily, so you get multiple tenants into
Right.
a property, so you've got more people kind of bearing that cost and sharing it. I think, you tell me, you always talk about how land appreciates and structures depreciate. So that means, I'm guessing, that if you're pushing further out of town, the land.
Right.
Tell me a little bit about how that equates.
So the way I explain it to folks is that in new construction areas, the model for a lot of builders is that the land cost is about 20% of the entire project. So you can imagine properties out in the outskirts of town, the way it breaks up is 20% is land, 80% is home. As you get closer into the middle of town, sometimes it's 100% land with a bonus property on it, or, but most of the value happens to be in the land. The land is the part of the investment, in my mind's eye, that appreciates. And the structures, the countertops, the walls, the paint, the wallpaper that we did a blog post on earlier, all of that, unfortunately, depreciates over time as it gets older and older.
So in a lot of situations like this, I think when we're looking particularly at a cash flow model, this is your spreadsheet people, your spreadsheet people. I think there are investors that really care about the numbers, and they're going to look at the data, and there's formulas and spreadsheets that are going to track that. And then you have kind of the camp I fall in, which is more of a gut. What do I see? Where is it going? Where is it playing into? And that's kind of that long-term appreciation and hold model. So first, it's all about cash flowing, and then two is the long-term appreciation. And ideally, you kind of want a little bit of both, don't you?
Well, I did, and you can have that, but it's harder to find. But when we start working with people, I like to kind of know: are you more about cash flow, or are you more about long-term appreciation in a really nice area, and you don't mind losing a little bit of money?
Cool.
To get started.
Let's talk a little bit about what people should look for. If they're trying to pick a good investment property, are there times of the year that are better for them, or cycles they should look for, or what kinds of property should they be picking? Do you have any suggestions?
Yeah, of course. The number one suggestion is location. If you do go after why can I not think? Multi-unit properties,
Sure.
multifamily properties. If you go after that, sometimes you can find really older ones that aren't quite in. A lot of the newer, more modern multifamily properties are in these zones where you have just duplex after duplex after duplex. But if you can find stuff that's outside of that, sometimes you can find a nice exit of turning those into like AB condos.
Oh yeah.
And selling those. So you always want to be thinking about in your investment property, what's my ultimate game here? What's my ultimate, way to exit the property? Because that's when you realize the benefit of that investment, right?
Sure.
So you kind of want to end game it. But you also, like if you're renting a house, if you're looking at renting a house, you probably want to think in terms of, well, as time goes by, I'm going to need to replace things, and how do I want to do that ultimately? You might not want wood floors in a house with a slab foundation. You might want to end up putting tile or something like that down so it's more durable, especially if you're going out like 10 years, so you don't have to.
Well, I think for me, you want to think about appreciation, particularly if you're doing that long-term hold. And you usually every January, and you did it this year again, you put out a list of neighborhoods that you expect there to be great appreciation in. I think one of the things is your planning is to look, where is development coming?
Yeah.
Where do you think there's going to be growth, and try to take advantage of getting into those neighborhoods early on, and then let that growth and that appreciation do the work for you. Like I think about where the new Apple campus is coming in. Several years ago, you were really talking about buying near the Domain.
Yeah.
Do you have any, is that good advice? Am I talking?
No. That's exactly right. So in Austin, we have a history of anytime there's development, we all think the sky is falling and the world's going to come to an end. There's going to be too much traffic and all this stuff. And the truth is, once all that development is completed, what really happens is all the property values around it go up, and everybody starts enjoying what was built there. So that was the play with Domain, still is, that Quail Creek area over there. We also like Anderson Mill a whole lot if you want to have longer term tenants, like with less turn, because the schools are off the hook. So if we can get you an investment property there, that's a really nice way to go. I'm also a big fan of, right here in Northwest Hills, there's some townhomes that I think are undervalued. And also the area right over there at kind of Mopac and Anderson Lane feels like it's really turning into a downtown. And of course you have the future of what's going to happen with Austin Oaks. And by the Grove would be nice. There's a lot of places around town. I'm happy I could probably go on for a long time just about that.
One of the things I also would suggest, and tell me if you don't agree, is like paying attention to the cycle of the real estate market. When the market, there's seasonality.
Yep.
So the fall prices tend to be a little bit lower. So if you're really in a hurry and you want to buy something, you could do it in the fall.
Yep.
Or if, you kind of look at where the market's going, like recessions or flattening periods. How do that,
Sure. So when the market gets softer, that's really the time to raise your hand and go ahead and buy something. It's harder to do because, the market's softer and everybody's not buying. So that's true.
Save for that rainy day so you have the money to invest.
Yeah, for sure.
When the market's in your favor.
For sure. But I think the big thing to do is to really just pay attention to opportunity. I don't think the market's going down. If you see something that's a great deal, you should really jump on it. Like it's not about always year round, or like when's the great buyer's market coming, when we crash in the next few years, which we're not doing, but people think in those terms. We haven't seen prices go down in Austin except for 2 times in the last 30 years, once in the 80s and once in this most recent, in the Great Recession. And both times we went down like 2 or 3%. So I wouldn't wait for a buyer's market, but I would wait for opportunity. In Austin, it's generally in the fall.
Well, to me, one of the ways I think I look for opportunity is I look at properties that other people might ignore. And you and I have both used that to our advantage. I kind of went off on my soapbox last week about bad photos and homes that don't show well. But some of those homes that have poor photos or don't show well are absolutely the ones that if you're looking at investing, you want to look at a little bit more carefully, because other people are going to blow by them. They're not going to be paying attention to those properties. The one that's got a hoarder living in it, or that's, super cluttered or looks gross, or it's definitely not on trend. That's where the gold is, in my opinion. I mean, those are the properties that other people are going to overlook, that give you an opportunity to kind of come in, do some real basic cleaning up, and really maybe use that poor marketing of that home to your advantage to get a deal.
Absolutely. Absolutely. If you could see value where other people can't, you win. But be careful, by the way. I just have to throw this out there. Like homes on busy streets that may give you a little bit more of cash flow, or homes with like permanent strikes. We want to avoid those, except for in the case like if you can time your sell and you feel really confident in it. You know, homes with those permanent strikes aren't always bad investments. If you can buy them in a slow time period and get a really, really good deal on it and sell it when it's hot, because those permanent strikes, they take a different size hit depending on how the market
takes longer to kind of recover from that.
Yeah.
Yeah. Well, let's talk a little bit about investment vehicles for people. Like if you don't just have enough cash on your own to go buy a bunch of properties, what are some options that people can consider for investing?
Well, you know, I'd start with the first round would be we'll get together with some friends and see if you can't pull some funds. I'm not crazy about that though, because there's always somebody who's dissenting, and like managing property as a group is always hard. But I'd rather you do that than do a traditional REIT. The problem I have with REITs is a lot of them are cash oriented.
Well, what?
Oh, sorry.
What's a REIT?
A REIT is a real estate investment trust. So it buys and sells on the stock exchange and all this kind of stuff. And they operate really with cash, which frankly violates my personal tenet of using other people's money. Mm-hmm. So if they're buying with cash, they're not really taking advantage of the money.
But basically people are pooling their money to allow them to buy usually large tracts.
There are different REITs, but generally speaking, they're commercial. And I think we got involved in one that was recreational properties or whatever. But you know, they're good, but they're not nearly as good as a rental property. I would, you know, instead of going REIT or cobbling together stuff, I'd find a property in my price range that works.
Okay.
Just try to find that.
Well, I like flips.
Oh, I know you do.
There's two kinds of flips. I think we got to talk about flips. And when we talk about investing, there's a quick flip and a slow flip.
Yeah.
Quick flips are harder to do in Austin these days. There was a time where you and I personally were able to get really amazing, like zero down loans. We were able to kind of get in there, get good properties, not have to come out of the pocket a lot, and do some quick fixing up and putting them back on the market. Are those days still here? No,
they're not. I mean,
I know you know no to me, but like to everybody else,
no, it's still an option. Yeah, but it's the risk reward isn't there. In my mind's eye, when I go, you know, everybody wants to do a flip, and we go out and we look. Take my little book that's sitting over here, and we write down all the things we need to do, and we do wild guesses on it. And we talk about what that's worth. You know, you might make 10 or 15,000 for a huge risk, and you may lose money. And it's just an incredibly competitive thing going on right now. Maybe when the market slows and people are less confident, it would be a good thing to do, but it's so competitive now.
Well, and depreciation. I mean, you're not getting deals on houses. I mean, you just had this weekend, our East 2nd Street property went multiple offers, 7 offers.
You can't talk about it.
I'm not. 7 offers.
Yeah.
Over asking price.
Yes.
The first weekend on the market. That's a competitive situation. There's not going to be margin in those numbers in order for you to have the money. I mean, because you've got to come out of pocket to put more money in it, and you've got to do the math, and there's formulas, and if any of you are interested in doing flips, we can talk about it. But a quick flip, I just think with where the Austin market is right now, it's really hard to find.
It's hard to do
a good deal.
It's
not impossible, but it's a lot harder to do. And you've got to be smart. I see a lot of people coming in and doing these quick flips where they get in it and they are either putting lipstick on a pig and they're just kind of quickly trying to do cosmetic things, but they're not addressing, like in Northwest Hills, I see a lot of flips where they're not addressing the underlying structural floor plan flow issues. So you still have choppy floor plans, and someone, you know, I walk in and I look at that and I'm like, you just put all this money into it, and I'm still going to have to come in and move walls and do structural things.
And they're cutting corners. I mean, that's my big beef. It's so competitive that for them to make money, it's not. I mean, it's kind of their fault, but not. But for them to make any money in doing this, and let's face it, that's why they're doing it. You got to cut corners.
Sure.
But they're not adding value when they do that.
And then there's the slow flip, and you like the slow flip.
Now we're talking. Yeah. I like it slow, baby.
Tell us about the slow flip.
So, you buy a nice house, and maybe you rent it out just like it is. So you let the land appreciate over time. You have it be a rental property, and then
or you live in it.
And over the course of time, you fix it up. You put 50 grand in there or whatever, and you doll it up, and then you sell it. And that's really the way to go. That's a much safer way to do it. But I tend to not want people to ever sell.
Yeah.
Not to talk myself out of deals or anything, but just holding them is really the thing to do.
Yeah, I think the slow flip is cool because you can find one of those properties if you don't have a lot of extra money to just go buy houses in addition to the one you live in, you can find one that you live in.
Yeah.
That might be in need of some love. You give it some TLC over a period of years. You put in the floors, you do new windows, you do the bathrooms, and you do it piecemeal. And then, in a couple of years or however long it takes, you let the market kind of appreciate for you, and then you're ready to put it on the market. And now instead of having that house that you moved into that wasn't super cute, you've got this more modern on-trend thing that you've updated. So it's sexy, it's market sexy, and you had the appreciation build up. So I like slow flips; those are fun.
I like slow and sexy.
Oh goodness! Now we're gonna have to cut this off. So, he's going a completely different direction, you guys.
Just saying.
Is there anything else you want to add? It is the last day of the February, and our theme of love.
We're still in the love month.
Yeah. Tomorrow's the last day.
Yeah.
So get it in now because there's no love after tomorrow.
So what I probably shouldn't tell you this, but what I've been telling a couple of sellers that I've gone to visit is, they're trying to figure out what to do, whether to sell or what's going on. And what I keep telling people is, hey, look, the home that you're living in is probably the easiest rental property you'll ever have to buy, rather than like going out and just buying a rental property. Sometimes if you could just take the home you're in and turn that into a rental property and hold on to it while you go buy your next house, that can be a really good, easy way to go build your portfolio.
Why wouldn't I like that?
Well, you'd like us to, I don't know, because you want me to sell more homes?
No. I think we did that. I mean, our first home, we kept as a rental for years and years and years. I mean, I get it. People have to make decisions that are smart for them. So anything else on investments before we wrap up episode 7 here?
No, I think that's it. Maybe we talk too much or whatever, but if you guys have questions or whatever, I get really passionate about trying to help people build wealth. It's a big deal. And most people in their jobs, it's almost impossible to save for retirement.
Yeah.
And, we think real estate's a good answer for that and for college education.
Do you hear that, Dad? Real estate's a good investment. It's a good way to build wealth.
I said so.
Yeah. So if you guys have questions and we didn't answer something that was on your mind, or you just didn't want to drop a comment below, always feel free to send us a direct message, drop a comment, send a text, call, whatever. We're happy to communicate with you about that. Also, if you have things you want us to talk about on Calls with Paul, send us an email or let us know. We're happy to address your questions. Otherwise, thanks for joining us for episode 7 of Calls with Paul, and we'll see you next week on Wednesday at noon.
That's right. And just to wrap it up over here, it's the last day of love, and I love you guys.
All right.
We'll see you on the next one.
See you next one. Bye.